Hi everyone, welcome to the session on shares and share capital. When an organization wishes to build up its capital base, then issue of shares is one of the option. So that is what we are going to learn today. Before going to the details of shares and share capital, let's have a small look on the term company. A company is an association of persons who contribute money or money's worth to a common stock and uses it for a common purpose. As per the Section 2, subsection 20 of the Companies Act of 2013, company means a company incorporated under this act or under any previous company law. Let's have a look on the features or characteristics of a company. Company is a voluntary association of persons and it has got a very separate legal entity. It has a common seal and it has a perpetual succession. Kinds of companies. Actually, the entire list of companies have been categorized into three major categories on the basis of formation, liability and public investment. Let's deal with one by one. The very first category is on the basis of formation and it has got subcategories as chartered companies, statutory companies and registered companies. Chartered companies are those companies which are incorporated under a special charter by the king or sovereign such as East India Company. The second one is statutory company, and these companies are formed by the special act of legislature or parliament like RBI. The third one is registered companies, which are incorporated under the Companies Act of 1956 or were registered under any previous Companies Act or any amended version of the Companies Act. The second category is done on the basis of liability. To what extent of liability the companies are having. So on the basis of liability, we are having three subcategories: limited companies, guarantee companies and unlimited companies. In the case of limited companies, the liability of each member is limited to the extent of face value of shares held by him or her. And in the case of guarantee companies, the liability of member of such companies are limited to the amount he or she has undertaken to contribute to the assets of the company in the event of its winding up. And the last one is unlimited companies. In these companies, the liability of the members is unlimited and members are personally liable to the creditors of the company for making up the deficiency. Such companies are rare these days. The last category is on the basis of public investment. We are having two subcategories, private and public companies. Private companies, these are companies by its articles, limits the number of members to 50 or prohibits the invitation to the public to subscribe their shares or debentures and restricts the transferability of their shares. And public companies are those companies which are not private companies, or these are the companies other than the private companies. Now that we got an idea with regard to company, its features and its types, let's go ahead with the share capital. The total capital of the company is divided into units of very small denominations and each of these is known as a share. According to Section 2, subsection 46 of the Companies Act of 1956, share has been defined as a share in the share capital of the company and it includes stock except where a distinction between stock and share is expressed or implied. Classes of shares. Basically, we have got two classes of shares. One is preference shares and the other one is equity shares. We'll go with preference shares first. Preference shares is all about enjoying the preferential rights. So the shares which enjoy the preferential rights as to dividend and repayment of capital at the time of winding up of the company over the equity shares are known as preference shares. and the holder of preference shares will get a fixed rate of dividend, which is a very huge advantage over the equity shareholders. We have got several subcategories for the preference shares. Let's deal one by one. So types of preference shares. The first category is all about cumulative and non-cumulative preference shares. In the case of cumulative preference shares, the arrears of dividend are carried forward and paid out of the profits of subsequent years. This is very crucial if the company is making loss during a particular financial year. So at the time of loss, the organization will not be in a position to pay out its portion of profit to the shareholders. So if the preference share is all about a class of cumulative preference share, then that right of having dividend will be carried forward and paid out of the profits of the subsequent years. And that is all about cumulative preference shares. If this particular right is not carried forward, or if the dividend are not to be accumulated to the coming years, then these are known as non-cumulative preference shares. The next category is participating and non-participating preference shares. This is all about whether the preference shareholders are having a right of proportion of surplus or not. So first of all, we will deal with participating preference shares. In addition to a fixed rate of dividend, balance of profit, that is after meeting equity dividend, which will be shared by some preference shareholders. If it is shared by these preference shareholders, then these are known as participating preference shares. And in the case of non-participating preference shares, the shareholder will be getting only the fixed rate of dividend. They will not be having any right of share in the surplus profit. The next category is the redeemable and irredeemable preference shares. If the preference shares are returned after a specified period to the shareholders, then these preference shares are known as redeemable preference shares. If it is not returned, then these are known as irredeemable preference shares. And the last category is convertible and non-convertible preference shares. These shares are given the right of conversion into equity shares within a specified period or at a specified date according to the terms of issue. If these kind of right of conversion has been made applicable, then it is known as convertible preference shares. If the shareholders doesn't possess this particular right, then these class of shares are known as non-convertible preference shares. The next major class of share is equity shares, and in very simple terms, equity shares are those which are not preference shares. Equity shares do not carry any kinds of preferential rights or preferential gain in respect of dividend or repayment of capital at the time of winding up of the company. So these are basically known as ordinary shares. There will be no fixed rate of dividend to be paid to the equity shareholders, and this rate may vary from year to year. In winding up, the equity capital is repaid very last. However, equity shareholder gets full voting power in the organization. Differences between equity shares and preference shares. Equity share is an ownership security, whereas preference share is all about a hybrid security. And in the case of equity share, dividend rate is not at all fixed, but in the case of preference shares, the rate of dividend is absolutely fixed. In the case of equity shares, capital is repaid only at the time of winding up of the company, but in the case of preference shares, capital is repaid after a stipulated time period. Equity shareholders have voting rights, whereas preference shareholders, they generally do not have the voting rights. And in the case of equity shares, the face value of the share is lower, and in the case of preference shares, the face value is higher. These all are the major differentiation between equity shares and preference shares. The entire share capital has been divided into 6 components or 6 parts: authorized capital, issued capital, subscribed capital, called up capital, paid up capital, and finally reserve capital. The first one is authorized capital, which is also known as registered or nominal capital. It is the maximum amount of capital which the company is authorized to raise by way of public subscription. And the rest of the components of share capital generates from the very base of authorized capital. So the next one is issued capital, which is that part of authorized capital which is offered to the public for subscription. And the next one is subscribed capital, which is that part of the issued capital for which the applications are received from the public. Called up capital is the next one. It is that part of subscribed capital which has been called up or demanded by the company to be paid off by the shareholders. Then the next one is paid up capital, which has been treated as that part of called up capital which is offered and actually paid by the members. Any unpaid amount of balance on the called up capital is known as unpaid capital, or in other terms it is known as calls in arrears. And the last component is reserve capital. It is that portion of the uncalled capital which is called up only at the time of winding up of the organization. I hope the concept of shares and share capital has been clear to you. Thank you so much for listening.